This is a video for Finance 303 with Professor Dow, and I'm Jim Dow. This video shows how you can use ideas from Finance 303 for personal financial planning. First, I will introduce the personal finance curriculum at CSUN. Second, I'll discuss how the personal financial plan works and list the basic parts of the financial plan. Third, I'll introduce the concept of net worth and connect it to a company's balance sheet. Finally, I'll show how to use time value of money calculations to plan for retirement. This slide provides general information on our personal financial planning courses, but you are not required to know it for the exam. Finance 102 is a general education course designed for all students that provides basic education on personal finance with a focus on skills you will need now as you go through college. Finance 302 is a course designed for all students that provides basic education on personal finance with a focus on skills that you will need throughout your entire life. In addition, we offer a number of specialized courses that can serve as electives for finance majors or minors. Individual courses focus on insurance, benefits and retirement planning, investments, a required course for both majors and minors, and tax planning. In addition, the Business Law Department offers a course in the principles of real estate. While not a finance elective, real estate can be an important part of a financial plan. For those considering a career in advising others on their personal finance decisions, the department offers a program leading to the Certified Financial Planners designation. Students interested in a career in financial planning or insurance should contact the appropriate department advisor. In an earlier PowerPoint, we went through the parts of a business plan and the business planning process. Individuals also have financial plans to help them with managing their finances. A key part of the financial planning process is determining your financial goals. It is important to have specific and measurable goals so that you can evaluate your progress towards achieving them. There are many possible goals. A short-run goal might be to pay off your credit card debt. A medium-run goal might be to save for a down payment on a house. A long-run goal might be to build up enough savings to live off during retirement. As with a business plan, individuals have financial statements to guide them in their financial plans. The basic personal financial statement is a budget, which is similar to the income statement for a company. The budget records how much you earn and how much you spend, with the difference between the two being the amount you save. The second major financial statement is the statement of net worth, which we'll talk about shortly. Given your goals and your current financial position, you then need to list specific actions you will take to achieve your goals. Let's say, from your financial statements, you see that you have $1,000 in credit card debt, but your goal is to have no credit card debt. Your actions might then be to not add any additional payments to your credit card and to use some of the savings to pay the debt down. On a later slide, we'll see how a goal of having enough savings for retirement is connected quantitatively to actions you take now. It's important to remember that financial planning is an ongoing process, not a one-time activity. You'll need to keep track of your actions to see if you are on target to meet your goals. For the credit card example, this is straightforward. Are you paying the debt down each month? How close is the debt to zero? For the retirement example, the principle is the same. Is your wealth increasing fast enough to meet your goal by retirement? But the calculation can be more complicated. There are a lot of details involved in financial planning. No single PowerPoint presentation could begin to cover them all. Here are two links that briefly discuss the major concerns addressed in a financial plan. Read through them and know the 6 areas of financial planning listed in the second set of slides. Also remember that while there is a lot of valuable financial information on the web, not all sources are equally good, and some are simply trying to sell you a product. Web pages mentioned in class are used to illustrate particular ideas and should not be considered recommendations. Do your research before engaging in any financial transaction. For a company, the balance sheet summarizes the financial position of the firm at a point in time. As you know, the balance sheet lists the assets and liabilities of the firm, with the difference between the two equaling the book value of the firm's equity. The equivalent financial statement for an individual is the statement of net worth. This lists the assets and liabilities of the individual, with the difference between the two being the net worth of the individual. For example, an individual owns a house worth $450,000 with a $350,000 mortgage and has $200,000 in investments. The individual's net worth is calculated as $450,000 plus $200,000 minus $350,000 equaling $300,000. Planning for retirement is an important part of any financial plan. You can use the time value of money techniques you learned in Finance 303 to help you plan. I'll set up a simple problem to show you how. The situation is that you are employed now, but you know you will have to live off your savings when you retire. The financial question is, how much must you save now in order to have accumulated enough money by the time you retire? This is a three-step process. Step 1, calculate the needed annual income when you retire, which determines how much income your retirement savings must generate each year. Step 2, calculate the amount of savings needed when you retire in order to generate the annual income determined in Step 1. Step 3, calculate the amount to save each year in order to accumulate the needed savings determined in Step 2. The next slide will give a numerical example. In practice, things are more complicated because of uncertainty, taxes, and a variety of other factors. These issues are addressed in more advanced classes, but the calculations still rely on the time value of money techniques you've learned in this class. Here's an example. You have 40 years until retirement, and you will live for 30 years after you retire. You need $4,000 per month to live on, and you have $1,000 per month from Social Security. How much will you have to save per year over the next 40 years? Step 1 is to determine how much you'll need per year in retirement. In practice, this is a complicated problem, but here we've been given the answers. You need $48,000 per year. You get $12,000 per year from Social Security. So the remainder, $36,000, needs to be generated each year from your investments. Step 2 is to determine how much money you must have when you retire in order to generate $36,000 per year. This is a present value of an annuity problem. Let's assume you earn 4% on your savings. N is 30 years. That's how long you are retired. I is 4%. Present value is what we are trying to find. Payment is $36,000, the amount you need to generate each year. And future value is 0. The answer is $622,513. That is, you must accumulate $622,513 by the time you retire in order to generate $36,000 per year during retirement. Step 3 is to determine how much money you must save while working in order to have $622,513 when you retire. Here we are finding the payment of a future value of an annuity problem. N is 40. That's the number of years you are working. I equals 4%. Present value is 0. We are trying to find the payment. Future value is $622,513. And the answer is $6,551. That is, you must save $6,551 per year when you are working in order that your investments will generate $36,000 per year when you are retired. Of course, this is assuming that you are running your savings down to zero when you are retired, and it doesn't leave any room if you live longer, or if your expenses are greater than expected, or if your investment earnings are smaller than expected. You may want to follow a more conservative strategy to provide some protection against those events. Although this will require accumulating more savings before retirement or having lower expenses after retirement.